Good morning, ladies and gentlemen, and welcome to this part of the program. The name of our speech today is called Economic Environments and Their Effect on Stock Market Evaluations. We are obviously in a very unique environment. Everybody's given a lot of thought to that. And I wanted to share with you something that I have been following for almost 40 years. Now, everybody looks at the stock market through the Dow Jones, through the Standard & Poor's, and that is a good way to tell what the price of the market is. It's not particularly a good way to find out what the evaluation is. And there are many things that are published on the price-earnings ratio of the Dow and the S&P and so forth. The thing that I always found the most useful is to look at what we call the value line median index, and that is because of several reasons. Number one, it is published every week, so you have an up-to-date price-earnings ratio on how the market is being evaluated. As the earnings come down, up and down, it'll cover that. Number two, it is not an average, and an average sometimes can be very misleading because there could be one stock like Apple that could drive the whole index. In the tech bubble, we had 10 stocks that moved the market 75%. This median PE is the middle range of a wide range of PEs on the stocks, so it gives you a much better idea of what the average stock is doing. In addition to that, it is 1,700 stocks instead of 30 on the Dow or 500 on the S&P. And one of the things that you'll see that is really amazing, except for one period that's very unique in our history, is that it fluctuates between 10 times earnings on the bottom and 20 times earnings on the top. There's only one little portion in the left-hand side of your chart that shows PEs of about an average of 7 to 8, and that's a very unusual period when we had 12 to 13% inflation, we had 17% interest rates, and that isn't the kind of environment we are in yet. So I would not apply that to our study. I'm using 30 years of history where the BAA has ranged from 4 to 5% where it is now to as high as 12 and 13%. So that's a pretty good indication. Now, one of the things you're going to realize about this chart is it doesn't matter what is going on, 10 times is about the lowest it's going to get. For example, in the 1990 recession, it got to 10.2. In the 1980 crash, where the market dropped 23% in one day, it went to 10.6. In the 1983, with interest rates at 13 to 14%, it got a little bit of time down to 9. And more importantly, in 2009, with the worst recession we've had, the greatest market decline since the Depression, it got down to 10.2. So there's only 4 times in 30 years that you have this market selling that low. But here's the most important thing about this. It's not only the fact of how low it can go, it's how much time it spends there. And it's truly astonishing to see how little time it really spends there. For example, if I took all 4 times it hit 10.2, or 10 and below, it was only 18 weeks out of 1,546 weeks. So in other words, it's only 1.2% of the time that it spends at that low. So when you get that value line, median PE, near 10 times earnings, you are at an absolute market low, and it almost doesn't matter what's going on. We've had recessions, we've had Nixon's resignations, we've had wars, we've had major panics, we've had the 87 crash. No matter what you threw at it, 10 times is about as low as it's going to go. And so that gives you a real good range to know where the market is, 10 at the bottom and 20 at the top. Now, I'm going to show you a value zone that if you buy into that value zone, you're almost sure to make money statistically. At least it's been that way ever since the market's been around. If we start off at 12 times earnings, a little bit above the bottom, The market only spends 13% of the time at 12 times earnings. That means 87% of the time it's going to be higher. So if you start buying at 12 times earnings, you have an 87% chance of being correct. If you average it to 11 times earnings, it's only 4% of the time. In other words, 4% out of the last 30 years, it's only spent at 11 times earnings. That's a 96% increase to the upside. And if you wait until 10 times, it only spends 1.2%. Now, the most important thing about this chart, and I'm going to show you a value zone, is that it doesn't matter what's going on. I know we have a lot of problems. We got the economic problems in Europe. We've got jobless rate problem here. We've got high debt. We've got all kinds of different issues coming up. We've got a slowdown in China. You put it all together, and when you get to 10 times earnings, you get in that value zone, you can do it. Now, a lot of people say, well, if you're older and your retirement plan, you shouldn't be aggressively in equities. Well, I would say that if you buy into the zone of 10.2 times earnings, it's only been there 1% of the time. It's actually 1 month that it spends at that time. You only have to live 1 month, and you're already making money. So buying into that zone is truly a good way to go. Now I'm going to move on to the next chart, and that's going to give you the value zone in yesterday's market and today's market. Now, if you look at the value zone today, the top part of your chart is the period from 66 to 82. Now, you can see that that's a 16-year period. You've probably seen this chart before. I've used it in many different seminars, and it shows the peak at about 1,000, and then there's a few drops below that gray line. But anytime you bought in that gray line, that value zone, you're bound to make money because the odds are in your favor 87% of the time. Now, there were 10 opportunities to buy into that zone during that workout, and this was a period of great difficulties for this market. We had high inflation, we had high interest rates, we had 2 severe recessions, we had Nixon's resignations. There's a lot of problems going on in this market, and yet the market was able to hold, except for a couple of panics, into that intrinsic zone. Now let's look at the bottom of the market, bottom chart, and I've drawn the intrinsic zone here, and you can see that the pattern is evolving the same way. And that is because when markets are uncertain, when they're not sure what's going to happen, when people are waiting to see the outcome, it's not going to get the high evaluation that we do during normal times. So I would expect this market for the next 3 to 5 years to fluctuate in a value zone just like it did in the 60s and 70s. And the reason for that is that all of these problems have to have some form of resolution before we have a greater growth rate and higher multiples and everything. And if you look at the chart today, you can see that the Dow, and I'm using it, but you can use the S&P. If you use the S&P, you just cut it by 10, divided by 10%, or 10 times. And you can see that the market on the Dow is at 13,275. It's quite a bit above the value zone. Matter of fact, it is about 35% above the value zone. But let me show you the difference. And this is important for pension funds. You have a lot of money in fixed income. You have a lot of money in cash or short-term instruments. And that could stay that way. But once that market gets into that zone, starting at 12 times earnings on the value line, not on the S&P or the Dow, I'm speaking about the value line only, you can see what a difference it makes. If you were to make new commitments at 10,000 and the Dow was to go to 20,000 in the next 5 or 6 years, which I believe is possible, you would have 100% return on your money or 15% a year. If you made new commitments now and it went to the same place at 20,000, you would only have a 53% return, which is about a 7% return. So the difference between buying in the value zone and buying at just normal times is that you're going to cut your return by 50%. And that's a very important consideration. So the value zone is a very important thing to consider. Now, the one thing that I want to point out to you is the one thing I want to leave with you is that irrespective of what the news is, this is what you want to use as your guide. Because if you use the news to buy and sell, you're always going the wrong way. You have to have a form of discipline that'll tell you, irrespective of what's going on, at some point these stocks are going to discount it. And when you see how little time they spend at that 10 to 12 zone, you can see that any time in there, even though it may go lower, you are in a wonderful buying range. And that is the most important thing to keep in mind. Now, I know with all the problems that are out there today, with 17 nations in Europe trying to reconcile their differences, having to completely renegotiate trade agreements, it's going to be a long way before these things are all resolved. You're going to have a lot of fluctuations in this zone, but if you wanted to use one indicator to kind of give you a bearing, I would suggest this. It's published every week. It's readily available. It's adjusted every week, I should say. And the other good thing about it is it's only looking 2 quarters ahead and 2 quarters back. It's not as much forecasting as you have with the Dow and the S&P. Now that we've talked about the situation and the trading situation we find this market in, I want to leave you with a couple of thoughts because, and I've mentioned that in my Corpus Christi speech, but the thing I want to mention to you, and this is what people are losing sight of, is the fact that while we have many serious problems and we have a market that is starting to get a little pricey, we have some wonderful things going on in this country that will probably be resolved in the next 3 to 5 years. And it's important to keep a focus on these things because you're never going to see them in the headlines. You'll see a little article in the corner of your newspaper, but these are big, big things. And the first thing I want to point out to you is the wealth chart. That is the ability of this country to create wealth. Now, I'm just going to pick a point in the midpoint. In 1982, the wealth of the United States public was $10 trillion. That's paying off all the debts. That's net book value. It moved up to $66 trillion in 2007. It dropped to $51 trillion, and it's back to $62 trillion today. So you can see that this country has an enormous capacity to build wealth. And that wealth is still there, $62 trillion. We keep hearing about the debt problem and how everybody's going broke, and maybe that's true of the government, but that is not true of the American public. They are in very good shape when it comes to the book value of their assets. So I want you to keep that in mind, and then I'm going to go through a couple of things here to show you the other difference. Here's a chart where I call it the wealth formula. As long as this country keeps this wealth formula going, we are going to have a great future irrespective of the problems. I want to point out to you that at the end of the war, we had as much debt as we do relative to GDP, and we were able to work that down from 95 to 100% of GDP to about 25 or 30% because we had tremendous growth in this country. So if we have the type of government and the administration that will foster growth, we can work our way out of this particular problem. It's been done before. But here's how you create wealth. First of all, you got to create businesses. The business of America is business. Now you create businesses, you create jobs. Jobs create consumer spending. Consumer spending creates sales and profits. Profits create capital expenditures into productivity. And by the way, the government gets to tax you every step of the way. So they are going to get their fair share if you guys are making a lot of money and creating wealth. And the productivity is what creates wealth. Now I'm going to give you 2 examples that are truly extraordinary. You've probably seen this before, but I want to emphasize it because you don't want to forget about this. So let's turn to the productivity chart that shows the agriculture situation. In 1840, we had 69% of the population creating enough food. In 1930, it was 21%. In 1990, it was 3%, and today it's only 1%. You take India. India still spends 52% of their population creating food. So you can see when you compare it 52% to 1%, that's a huge difference in productivity. Even China, which has made tremendous leaps and bounds in their productivity, still employs 37% of their people in agriculture versus 1% for us. So this is an extraordinary demonstration of what productivity creates, and you want to keep this in mind as we move into the future. But the most dramatic example I've ever seen, and I would urge you to read the book Freedom's Forge by Arthur Herman. It is a phenomenal book to show you what we were able to do in the Second World War once we really made a commitment to increase our productivity in war equipment. We were completely flat-footed when World War II started. Hitler had been preparing for war for 10 years, and we still had the war equipment of World War I. They had overrun France, England was on its knees, and they were making great strides all over the world, and America had not even prepared for war. Finally, Churchill convinced Roosevelt to get the war equipment going. He hired Bill Knudsen, a Danish immigrant who started at the bottom of the floor in General Motors and rose to the presidency. He harnessed all of American industry, and what they did was just phenomenal. In 1940, General Patton had 325 tanks in his brigade. He was so short of spare parts, nuts, and bolts, he ordered them through the Sears catalog. The U.S. government was out of them. By the time the war ended, we produced 86,000 tanks over a 5-year period. In the planes category, we were producing 1,000 planes a year. By the time the war ended, we were producing 57,000 planes a year, and we produced 286,000 planes in a 5-year period. In the merchant ships department, we were only able to produce 4 ships a month, and by the time the war ended, we were producing 147 ships a month. And if you turn to the next slide, you'll see something that's truly amazing. Here is the Liberty ship that used to take 8 to 9 months to build, and when Bill Knudsen and Henry Kaiser got on it, they were able to produce this ship in 10 days, and Henry Kaiser even had a contest where he put everybody together, and they actually produced this ship in 5 days. It wasn't sustainable, but 10 days was the clip that they were working on. This is what happens when we harness our productivity through the proper incentive, through proper legislation, and we have a commitment to do it. That ability is still there. And now I want to spend a few moments talking about one of the most exciting things, and that is the natural gas. Just this weekend, a very small article, it should have been headlines, but a very small article talked about the productivity that hydraulic fracturing has brought to natural gas. For the first time, we are going to be able to export natural gas rather than import it. Exxon is building a $10 billion plant and asking permission from the U.S. government to be able to export it. And when we export it, it's going to be a gusher. We can produce it for $4 to $5 a million cubic feet, 1,000 cubic feet, and we can sell it for $12 to $16 in foreign markets. It costs us about $4.50 to ship it, so you can see from $8 to $12 and $16 that that's a lot of room. But the most important thing about this phenomena, and it is just breaking records all the time, we now have 100 years of natural gas reserves, and they're increasing all the time. This has brought about because of the productivity that is happening in natural gas production. And while it is not going to be a big thing in the next 6 months or a year, these are the kind of underlying trends that will propel this country into prosperity in the next 3 to 5 years, and also a major bull market after this back and forth thing that we have experienced over the last few years. The next thing I would like to mention is the fact that the housing market has obviously bottomed. Now, there's a lot of people who still disagree with it, but the evidence is pretty much in, and it's basically a simple thing. There's about 2 or 3 million new people at age 22, household formations. They are continuing to increase. They're moving into apartments now. But if you look at the next chart, the affordability in this country's real estate market is the highest it's ever been. So anybody that wants to buy a home, this is the most affordable times that you can see. So when you think about the productivity, when you think about the natural gas, when you think about the fact that we will become the low-cost producer in energy, that means there are already many companies bringing their factories over to the United States because the energy cost is going to be cheaper than anywhere in the world. In Japan, they're paying $16 for natural gas. They are bringing all their manufacturing over. They have stated that they cannot compete in world markets with the yen the way they are. They're bringing most of their manufacturing over to the United States. So when you have the productivity, you have the natural gas, you have the real estate market bottoming out. Let me say another thing about the real estate market. The real estate market is 22 to 24% of the economy. It isn't going to provide a tailwind for a while, but it certainly has stopped being a headwind. And so just the fact that that's not dragging it down is going to give it a boost. And so when I look at the population, when I look at all of these facts together, I think 3 to 5 years, and there will be some major changes in this country. And I want to wrap it up by saying this way. The United States has some unique things that no other nation has. It has universal recognition of the currency. It has a democratic system that is able to correct the mistakes of the previous organization. It has the largest liquid market in the world, and it is these things that attract people from all over the world, talent and capital, to build this country. And the last thing that we could be seeing that could be a huge difference is immigration reform. That is one thing that we have still failed to do. We are educating all of these talented people around the world, from around the world, and then we send them back home because we don't give them citizenship and green cards and so forth. I think that's going to come up as a major issue in the election. And if it does, it is going to help us in many different ways. We are a nation of immigrants. That's been the heritage, and the future obviously has to include immigrants as well. I can give you one statistic that was in the paper the other day. It said that 40% of the Fortune 500 companies was founded by an immigrant. So you can see the influence that people from all over the world do to live the American dream, just like I have experiences coming from Europe out of the war, and to be able to come over here and build a new life. It is all of these things that lead me to believe to be very optimistic about the long-term future, but I do not want to ignore the short-term problems and a market that is getting into overvalued territory. So I would urge you to consider those things, and if and when the markets get into that way, especially for pension plans to be able to take a long-term approach to the equity market, is a very positive thing. Thank you very much.